And then it was all this free money, this QE that means absolutely nothing. It just pushes fiat money asset prices up and all asset prices up. So you think everything is okay. But if somebody has to go to the grocery store and put the food to feed their family on 4 easy payments, it ain't okay, people. It is not okay. When do you want to know? When do you want to do something about it? Because now we got to take some questions, but we're going to be working on this really hard, really quickly to get this to you, because this is from the very early Federal Reserve. Remember, on all of my work, I put links. You can go and read this whole entire thing yourself. And I suggest that you do, because it's really eye-opening. I don't remember if it's this piece that said it, but quite honestly, reading and researching how they set the system up, what did they say? Corporations wanted to be able to pay you less, but they knew that if you were used to getting a certain amount of money, you would not accept less, especially on a gold standard. That is a fixed cost. However, governments, what would they want to do? They wanted to be able to tax you more. But when you're on a gold standard, you know about it, and you just might not agree. That is based on flippant debt. And what is debt? Debt is the money of slaves. Gold is the money of kings. Silver is the money of I don't remember how that whole thing goes. But silver is the money of something. And then barter is the money of peasants. Debt is the money of slaves. Let's not be debt slaves. We have a choice on this. He pulled it up. Thank you. Gold is the money of kings. Silver is the money of gentlemen. Barter is the money of peasants. But debt is the money of slaves. And that is attributed to Norm France, author of Money and Wealth in the New Millennium. I don't. That is not what I want for our future. And honestly, there is nothing that's more important than fighting for our children's future. We have that obligation. So now I'll go ahead and take questions. And Gina Young looks really excited because it's all caps. Hi, Gina. Hi, Zang Gang. Hi, Lynette. You look good today. Oh, thank you. I'm hearing President Trump is going to abolish the Fed. What exactly would that mean for we the people? Wow. Number one, if we were on a gold standard, the Federal Reserve would not be necessary. So, and President Trump does believe in gold, and he is a transformative president. So I believe we have a shot at him putting gold in the system again. And there's some other reasons for that, which we can talk about that. But if the government fully absorbs the Federal Reserve, then there will be absolutely zero police on the block, meaning that as much of this as they want, obvious to the population. Remember, what's the Fed's job? The Fed's job is to regulate the rate and speed of that inflation. And their job is to keep it at a low enough level so that you and I don't change behavior. We don't ask for a raise. We don't change our spending patterns. That to them is price stability. So in that regard, eliminating the Federal Reserve, there's no regulator of the rate and speed. So dropping the interest rates that the president wants by 300 basis points, taking it back to 1%. Well, what that means, not that they're great police, but until we get into the new system, there's your hyperinflation, because there would be absolutely zero restrictions holding back a truly unlimited amount of money printing, which is what the stablecoin set up anyway. It's different doors. It would not be good at this point. What the president is saying is the dollar's overvalued and he wants to take the dollar down. Anytime they lower interest rates, that's what they're saying. They want to reduce the value of the dollar, whether they realize that's what they're saying or they're not. He is a businessman and he understands debt because he's taken on a lot of debt in his career. And what does he want? He wants to be able to take on that debt as cheaply as possible. But there are two types of debts. There's self-liquidating debt and there's non-self-liquidating debt. So self-liquidating debt could be something like, okay, I own a business and I want to expand. And so, the best way to do it is self-fund. Non-self-liquidating debt is the government builds a bomb that costs billions of dollars or millions and millions of dollars, whatever. It blows up. That's it. You're not getting that money back. Credit cards. Non-self-liquidating debt. You're spending that money and you have to go elsewhere to get the money to pay that debt off. So what we're talking about are interest rates and all the interest that we're paying on all of this debt. That's in fact, all of this government debt, it's always said to be self-liquidating debt. Wow, if we do this, it'll stimulate the economy. We'll make more revenues. We'll pay this debt off. Well, truthfully, the intention is never, ever, ever to pay this debt off. That's not the intention of the system. It is to compound that debt. That means it's non-self-liquidating because all they do is borrow more money to pay the money that they already owed. So for you and me, you're taking out a new credit card to transfer the balance, and then you can keep spending. That's non-self-liquidating debt. This is dangerous. Now, we go into a new system that is regulated by the amount of gold that's in the money supply. Let's say it's 40% of whatever they print. So it makes you more thoughtful. So I know that was a long question for that, but yeah, I mean, at the moment, the Federal Reserve is moderating the rate and speed of inflation. When President Trump eliminates the Fed, because whether it happens now or it happens, I mean, he's got his people in there to make a difference, and they will make a difference long before Fed Chair Powell's tenure is up at the Fed. Pretty sure he won't be staying on after that. Yeah, it's dangerous. I guess that's what I'm saying. And the level of confidence that the world would have in the U.S. would be diminished drastically. And El Claire Trio asks, what would happen if we got rid of the Fed? Would it really matter? Well, yeah, I think I kind of just answered that. I mean, now, not that they're not going heavily into the new stuff at this point, but it's not fully adopted, but there is a huge push. And if you haven't noticed it yet, or your friends or your family, those people that refuse to see what's happening, it is possible that they're going to see it and be more open to what this conversation is that you and I are having pretty soon. Okay, Wolf asks, Lynette, could you please describe what to expect and what will happen on the day of a financial collapse occurs and after? Well, I don't think you need to think back very far. We could definitely go to the great financial crisis in September of 2009, 24 hours. So since this is all based on more debt and more credit, right? So those debt markets freeze. And for any of you that were in the mortgage or industry or about to get a mortgage, 24 hours, those opportunities evaporated. 24 hours. So when they go into a financial collapse, it is it's slow at first, right? We were getting signals a long time before. I started yelling in July. I'm pretty sure it was July 9th. I could be off by a couple days. And told them that when I got back, I was going to tell my mom she needed to liquidate her stocks because I just got the most ugly signal that I've ever gotten when the dollar fell to its lowest level ever. This is a world reserve currency against its trading partners. It freaked me out. I'm not going to lie. And I at that point said something nasty this way comes. And it wasn't that nothing happened between then and until the public noticed it, because there were a number of mutual funds and mutual funds really that went belly up at Bear Stearns, and they were AAA rated and had lots of money in them. And everybody was saying, oh no, everything is fine. Everything is fine. Everything is fine. And then those people woke up the next morning and there were two major funds. I can pull this up if you want, I can put this in since we're taking another minute on this, but two major funds gone overnight. So that's what it looks like. And, if you look at afterwards, you're going to see rights. You're going to see all of these assets. And we've got a little snicker snack of that in 2020 and beyond. But all of those assets that were accumulated on debt, when we're going to see a run on the financial system, and all of that debt that was accumulated at zero interest rate policy that's still sitting on the books of the banks and the central banks, telling you this issue has not yet been resolved. All of that gets very ugly. We don't just have zombie corporations. We have zombie agencies. The Federal Reserve is a zombie agency. And that is, a zombie corporation is any corporation that has not been able to pay all of its interest on the debt it owns from its earnings, let alone any of the principal. And that is true for at least 3 years. 3 years, that's the threshold. Well, I just recently did a piece on the losses at the Federal Reserve and the fact that they have not been able to pay the Treasury that excess from creating this $100 bill costing 9 cents to you, and I have to work for this $100. That's their profit on there. We're now in the fourth year of that, So we've got zombie corporations. We've got zombie agencies like Freddie Mac and Fannie Mae. Those have been, they kind of nudged that real estate market along, but boy, they got whammed in 2000 and the savings and loan crisis again in 2008. They haven't recouped. Yeah, those zombie corporations, zombie agencies, quasi-government agencies, and a zombie Federal Reserve and a zombie government because we can't pay our debt. We can't pay the interest on our debt. We could pay the fake interest on our debt, like the current, maybe, but not really. Yeah, we're surrounded by zombies. Well, this is not a good thing. Those zombies, we got to kill them. Tiana Licks asked, my niece's name is Tiana too. But Mrs. Lynette, I was hoping you had the answer to my question. I asked about 2 weeks ago, would your company purchase? You did ask me that 2 weeks ago. You did. Let me find out. Oh, I don't have my phone. Josh, can you email Emerald, please, and ask her that question? If we will buy back 92.5 jewelry once things go digital. We would totally do it on the coin, 92.5. So that's like 22 carats is what you're talking about. So I will find that out for you. Thank you for holding my toes to the fire. I really appreciate it. And please forgive me for being a little lax. But Josh is here and he's very proactive. Okay. And we might have that answer before the end of today. So let's find out. First of all, we started creating new coins in the 80s again. But that is accurate. These coins, like this one was minted in 1903. It is not 99% pure. This is a new American Eagle and it is 99 pure, but it's 92.7% pure, which is 22 carats. This would be 24 carats. This is 22 carats. This is more durable. And since the coins were used in circulation, they needed that extra level of durability. The new coins that are being created are not intended to be in circulation. They don't need that level of durability. However, I don't know what that slabbing looks like, but if it's pre-33, that's a good thing. We didn't create any coins between 33 and 75. We didn't start creating coins again until 86.